Are you planning on selling weekly or monthly covered calls for income? I'm going to cover a current trade I have for you with the entry, strike price selection, expiration date, and a full guide on how I've used this strategy to generate tens of thousands of dollars per month. After learning this strategy and studying it at Goldman Sachs and my personal experience of trial and error, I found the safest sweet spot to implementing this simple strategy for anyone. I saw this strategy implemented a lot by high net worth individuals for its income potential. Many clients with 7-figure, 8-figure, and even 9-figure portfolios do simple covered calls on stocks to generate income. That's from my experience from exactly what I saw when I was working at Goldman Sachs. So I realized that covered calls are literally one of the best strategies for generating consistent, safe, and passive income. I personally usually go for a 30 to 40 delta for a covered call, but it really depends, as you will see when I dive into an example. That means I pick a call to sell that's near the money usually, as you will see when I open my first position. Covered calls are the best risk-adjusted strategy. They create an instant income and provide a margin of safety if the shares of the stock you own pull back. It's also great because with a covered call, you can collect dividends plus income from the premium you collect when you sell a weekly and a monthly covered call. That's why I've been telling students, do something like ExxonMobil or another high dividend paying stock. If you use a covered call on a stock that already pays dividends, you will actually collect a 3% dividend plus potentially 12% more in premium per year, or maybe more than that, 15%. And you combine these two, you have a very good retirement strategy. Let's jump into the first example, but first I do want to ask, if you have a second, please go down there and hit that like button. You don't need to purchase any Patreon subscriptions, courses, or anything like that from me. All I ask is you hit the like button for me. That way I know I'm creating content that you like so I can make more of this type of content. I'm here to educate first. I care about your results and my reputation more than a few dollars in my pocket. Liking and subscribing is really all you can do. I don't really ask for anything else. All right, so let's go through the first example. What I'm going to do is I'm going to pick a stock that I like and I want to do a covered call on it. I actually currently have a covered call on Alibaba. I have sold the $89 call option. And as you can see here, I am up $5,400 because I actually did sell an in-the-money covered call because this was a roll, which we can talk about later in this video. But let's just talk about setting up a covered call successfully. Let's just pretend I don't have shares and I'm not making $11,000 on the stock and I'm not making $6,872 on the stock. So let's just start this position from scratch and pretend that I'm not already making money on it and pretend that I don't have 1,000 shares. So let's just say that I want to buy a couple hundred shares of Alibaba, or let's just do 100 shares, okay? That would be $9,400. So I buy 100 shares, I have $9,400 invested in Alibaba, cool. Now I can hold my shares and see what happens. But this is where the covered call comes into play because a stock itself like Alibaba doesn't pay any dividends, so you really don't know what your return is. But when you sell a covered call, you're able to collect income. You're able to generate some premium by selling a covered call option. So the first thing I'm going to do is make sure that I am selling a call. Can't tell you how many times I've had students buy calls and they meant to sell. So please make sure you're selling a call option. Next thing is picking an expiration date. So for me, I like to go out about 1 week, but I'm also not opposed to going out up to 8 weeks. So 1 to 8 weeks is fine because that's where time decay and theta really starts to kick in. For this example, I'm going to go out just about 3 weeks. So I'm going to go to May 19. If you're watching this in the future, this is relevant anytime that you watch this because options don't really change. As long as you know the strategy, you're able to use it far into the future. So we're going to pick May 5th, 19 days out. And what I'm going to do is I'm going to go ahead and sell a covered call. Now the thing is, what strike do I pick? And how do you even pick a strike? Why would I go for a certain strike versus another? Well, let's actually compose and see what the point of picking a strike is and how to actually differentiate one good strike from a bad strike. I just want to say that there's no actual bad strike. You can actually go in the money and sell a 90 covered call and this would be fine. You would actually collect a lot of money. And as you can see, the break even is 96.68, which is higher than the current price. And as you can see, the break even continues to rise the more out of the money you go. So if I go to 100 covered call, you'll notice that my break even is pretty high. That means you can actually sell this stock and make a profit up to $101.86. Now, the reason why this increases is because the higher you go, the more capital appreciation you have for the stock itself. But you are also limited to the strike. So for example, if Alibaba goes to 500, you're stuck at 100 plus the premium. That's why the break even here is 101.86. If Alibaba goes to infinity or like to some really crazy number, you cannot actually make more than the strike price that you sell. That is one of the negatives of covered calls, is you are limited. However, you are selling that limitation for premium. So in my opinion, it's very worth it, especially if you think, for example, Alibaba cannot go past 100 or whatever stock you're using. You can use Apple, Microsoft, Tesla, whatever you wish. Say you don't think that stock is going to go past $100 per share. Then there is no point of just holding the stock. You might as well sell a covered call because now you can make some money from the premium and you don't think the stock's going to go higher than this price anyways. So you can say you don't think the stock will go higher than 105. You want to pick a strike where you see that there is some resistance. So you want to pick a strike price where you see resistance for that stock. So if you think the stock can't really go higher than a certain price, that's the exact strike price that you want to sell a covered call on. For me, I also have a different method of picking a strike price. Honestly, if I'm happy with the stock making a certain percentage return, I'm just going to sell that strike price. So for example, let's say that 3 weeks out, I just want to make 3%. So what I'm going to do is I'm just going to say I want to make about $300 in about 300 weeks. So as you can see here, that would actually be even at the money. So I'm perfectly happy to sell an at the money option right here at 95 and collect $360. But let's say that I want some capital appreciation, but I still want to have a very heavy premium that I'm collecting. So if I still want to make my 1 or 2% a week return, then I can just go for something like 97. Yes, this right here is about 2.5% return, which is just shy of 1% a week. However, I still have capital appreciation built in. I have about another $300. So right here, I can actually make about 5% in 3 weeks, which is over my 1% threshold, which is between my 1 and 2% goal per week in collecting income. So this is my first example on Alibaba. Let's get into my second example. Let's use Apple because I currently have Apple as a covered call in my portfolio. The reason why you would want to do covered calls on things like Apple or Microsoft or Amazon is because a covered call strategy is a bullish strategy. At the end of the day, it's very simple. You have 100 shares of a stock, and then you sell a covered call collecting income on your stock. Basically, you're putting your stocks to work. You're telling them, hey, don't be lazy. Don't just pay me some dividends. I want you actually to produce me income, whether it's weekly or monthly. I'm going to go over 2 different examples. But essentially, a covered call, you're selling a call option and collecting premium on that position that you have, okay? So currently I have 1,200 shares of Apple. And as you can see, I actually have a covered call position. I just recently closed off a big winner in my Discord community, so I just opened this up today. If we go to my history, you'll actually see that I have opened this up just 3 hours ago and I rolled, okay? Previously, I actually bought back a 150 call for $44. I previously sold that for a lot more, so I made a really big profit. But, let's do step by step, okay? So let's take this example. Let's say that you have 100 shares of Apple, okay? $142 per share, okay? Mine is actually $145 average per share. Okay, you're gonna go to trade Apple options. And now, whatever your average cost is, if you buy it at this moment, you can sell a covered call that's just slightly out of the money. So for example, let's say that you bought 100 shares at $142. Now what you can do is you can go sell a call option and you can sell a little bit out of the money. So this is December 16. If you're watching this in the future, we could just go out like a month, but it doesn't really matter because the whole gist is wherever you buy a stock, you're selling a covered call that's slightly above the current price, okay? So for January 20, which is roughly 1 month out, I'm going to go ahead and actually sell the 150. So here, what you're going to notice is there's 2 components to this position. The first component is you have stock. So the stock can rise, and that's where you can see upside and actually make a gain on your stock. So if you bought for 142 and it goes up to 150, you can make like $8, right? That's $800. Now, if you sell the 150 strike, you can also collect $330 worth of premium. So this is a fantastic way into entering a covered call because whatever price you buy it for, if you sell an out of the money option, you can only win. Either the stock goes up, you win on the stock, and you win on the covered call. The worst that can happen is you just sell it at 150, right? Now, another example of something bad that can happen, what scares people, but in actuality, it's much safer than owning stock, is say the stock goes down. Let's say that it goes down to 140, so you lost $2. Well, the thing is, as a stock investor, you lost $2. But as a covered call investor, you still lost $2, but actually you've collected $330. So although you've lost $2, you're basically collecting $3.30 per share. So you're actually going to be better off than the stock investor by selling a covered call. And that's because you have a margin of safety. When you collect this income, you can actually experience a little bit of a downside and still be okay. You can also experience the stock doing nothing and still profit by $330. Or even if the stock goes up to $150 per share, you still get that upside and you get your $330. That's why the financial advisor was telling us that covered calls are like literally the ultimate strategy to becoming a millionaire, and they're the most consistent way to grow your wealth. And that's actually the only strategy that he used for NBA players, which had me actually kind of scratching my head because, well, if this guy has a lot of experience, wouldn't he use every single strategy in the book? And that's kind of when I realized that you don't need to get really fancy with option trading to make a lot of money. If you keep it very simple, you can actually be very consistent. If you dial in your knowledge, you dial in how to pick the perfect expiration date, the perfect strike price based on fundamental and technical analysis, you can really kill it. And you don't have to get crazy with spreads or iron condors or Christmas trees. A simple covered call strategy done correctly can make you, as you can see here, $330, which is actually a 2% return in about a month. Not only do you get a 2% return in about a month, you also still have upside to the stock itself. So when you enter this position, you have an expectation that you can make upside about $8 in this position, which is over a 5% return in 1 month, and the premium itself is another 2% in a month. So this position right here, you can make about 7% returns in 1 month. Now that's a very high return on a consistent basis, and the reason why it's going to be tough is the stock is not always going to rise. But when it does, you can make a 7% return per month. When it goes sideways, you still collect a 2% return per month. And when you go down, well, you're still better off than the stock investor, right? We will still get affected by the market because this is a bullish strategy. So when the market goes down, you will still be affected. However, your total maximum profit is going to be much higher than just a stock investor in many different scenarios. And by the way I calculated my percentage upside was I just took this $330, I added it to the strike price, and as you can see, Robinhood already does the answer for us, which is $153.33. You take this number and you divide it by the current price of the shares, okay? So that's going to be the upside that you have. So another important factor that I like to look at when doing covered calls is momentum. If the stock is rising, then basically it is a very good candidate for doing a covered call. And basically when I was working on Wall Street, when I worked for Goldman Sachs and another hedge fund called PNC Capital Advisors in Philadelphia, I realized that a stock that has good momentum that's going up is likely to keep rising. That's like one of the biggest secrets is it's pretty simple. If you look at a chart and the stock is rising, it's likely to continue rising, okay? There's not that much more to that story. And the reason is because for whatever reason, we don't know why, but when a stock is rising, maybe it's insider purchases, maybe just because a lot of investors are becoming bullish on it. But for whatever reason, the stock is proven to continue going up. And for that reason, you want to use a covered call strategy. Because it's not like it's 100% going to rise up, but by using a covered call strategy, not only are you going to ride that momentum, but you're also creating yourself some income along the way. And speaking about covered calls and momentum, one software that I like to use is OptionsFi. I basically take a look at this software as a recommendation tool and I use it to get some ideas. And lately I've been doing a lot of covered calls on things like Apple and Google, and that's because I see it being recommended here and it's been working out really well for me. Basically, it recommends an expiration date and it recommends a strike price as well. So let's check out this play right here on Apple 147 sell call for December 16th. So again, I'm going to go to Apple. December 16th is going to be a very short expiration day. That's going to be in just a few days. Again, if you're watching this in the future, short-term covered calls are still fantastic. Whether you go for 1 week, 2 weeks, or 4 weeks, that's still fine. The reason why you want to go a little bit shorter term is because options that are short term have a very high theta. Now, for me, I have sold at 146, but the software was recommending 147, which is really close to what I would have done anyways. So looking at the 147 strike, there's a few things that I really like to look out for, okay? This is exactly how you're going to enter into the option position pretty perfectly, okay? So the way to actually do it as perfect as possible is a delta of about 0.25 to 0.4, okay? It really depends. Now, why does it depend? A 0.25 delta is much better for volatile stocks. Since volatile stocks can move up and down a lot, for example, Tesla, you're going to want to go a little bit lower delta. And that's because a lower delta is going to be further out of the money. And the further out of the money the option is, well, you have more upside. But if a stock is not that volatile, for example, looking at Apple, it's only 49. That's not high, but it's also not low. That's somewhere in between. And that's why a 0.3 delta is perfect. Because for a very volatile stock like Tesla, you might want to go further out of delta like 25, okay? For a medium stock like Apple, about 30 is fine. And then for a very low volatility stock like Coca-Cola, you might even want to go as high as a 40 delta. And that's because the stock isn't really moving that much, so you can go closer to the money. But for Apple, it's somewhere in between, and that's why a 30 delta is fantastic. So I'm going to delete this $150 call option for January, and I'm going to go just a few days out to 147. Here, as you can see, the premium is a lot lower. The reason why the premium is lower is because options have a lot of value from time. Here's the theta. The theta is 0.32, and what that means is for every single day, this option is losing about $32. But if you're an option seller, that's actually a good thing, because as this option decays $32, you are making $32 as the seller. You hope that this option doesn't explode and go up too much. Well, if it does, that's fine because you have the shares. You are covered. That's why it's called a covered call. Even if Apple went up to 150 or 160, well, that would be fine because you're protected because you have shares. But the one bad thing about covered calls is you will have to sell your shares at the strike price. And that's basically where management comes in. To be honest with you, I typically don't do any management. I just let the position expire on the very last day. And if this position is in the money, I will end up losing my shares. And if it's not in the money, well, that's a really big win for me because I've collected income. And even if the stock went down, I'm still better off than the stock investor. Now, covered calls are fantastic for consistency because basically, if the stock market moves sideways and you're doing covered calls, you're going to end up making good money. If the stock market goes up and you do covered calls, you're also making good money. And even if the stock market goes down, you have cushion and you still have income during the tough times. That's how I've been able to outperform the market this year. I have outperformed Kathy Wood and I've outperformed every single YouTuber. And that's because most people are buying hype stocks or really risky stocks. What I'm doing is I'm focusing on good growth stocks like Apple, Amazon, Microsoft, and all these other tech stocks, but I'm using covered calls on top of them, basically making my tech stock portfolio safer and generate income for me. Now, the more money you have, obviously you can snowball using covered calls and catapult yourself to becoming a millionaire very quickly. And then, obviously the more money you have, the easier it is just to make big numbers per month. But you don't have to start there. You can just start with $5,000 and you can use covered calls on things like, really cheap stocks like Hims or Oatly or whatever stocks are going for just a few dollars. A lot of stocks I do follow are somewhere in that $90 range. So it does take a little bit bigger of a portfolio. But if you look at Hims, it's only $7. So you only need $700, and then you can sell a covered call at like $8. And there you go. Your $700 can grow to $800. And you could do that every single week. So if you have like 5 of these positions, then basically you can make $100 a day. So I would absolutely use covered calls as a main strategy for growing a small, medium, or large account. But if you're dealing with a really small account, then maybe you want to do poor man's covered calls. And I have a video that you have to watch if you want to grow a small portfolio right here.